Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Sylvia Jablonski, CEO and CIO at Defines ETFs. We're talking about the second half market outlook and some very interesting investing themes. Sylvia, welcome back. Great to have you on the show.
Thanks so much for having me again, Nina. Great to be here.
So we are approaching the end of the first half of 2024, and the stock market is still on a tear, and that's thanks mainly to enthusiasm for AI and driven mainly by NVDA. And in fact, NVIDIA has accounted for almost a third of the S&P 500's gain in 2024. And Sylvia, I recall when we spoke last time, you were quite bullish on stocks and particularly technology stocks. So I'm sure the tech rally did not surprise you, but I'm still curious to hear about what surprised you about the market performance this year. We have seen this Mag 7 trade kind of fizzled, and then traders started talking about the Fab 4 and now even Mag 1. And lack of market breadth has been a concern for many. Did that concern you?
Yeah, it's certainly been an interesting year, and to your point, NVIDIA is a third of the growth in a major index, right, in 2024, and it's actually the cause of the growth in a lot of the thematic ETFs and tech ETFs and semiconductor funds and whatnot. And so, it didn't surprise me that tech rallied. I expected it to. I expect it to also in coming years. I think that, when you have this type of disruptive innovation that is actually, happening, and we're starting to see reports about the end results and things like revenues coming from this and actual sales and actual, forward-looking orders and things like that, meaning it's tangible. It's not like a pie in the sky thing that a lot of times like we're thinking a trend or an innovation might play out, and we're saying 10 years from now this could happen, and it's important to have that kind of view. But it's really good when you believe these things are going to happen, and then they start, it starts coming to fruition in earnings season and things like this. And so, the outlook for corporate earnings for tech in the coming years still, high teens, single digits. And so it's not really super surprising to me that tech is doing really well. I do think, though, that, a healthier bull market would be one that shows some level of expansion or breadth outside of the, Fab 4, Fantastic 5, so whatever we're going with now. And I think, that would kind of make me feel more confident about, year end with the, broad-based market as a whole, but I'm not so worried about tech. I mean, I think it'll ebb and flow. We'll get some pullbacks like we did with NVIDIA. Those for me are just buying opportunities. Election year, seasonality, the markets are fueled with some good, good momentum now. And I think like it doesn't hurt that inflation is cooling and the Fed can start thinking more about cuts being a little bit more, proactive in terms of making that decision and things like this. So I'm still bullish. But yeah, what surprised me though is that I do think that other parts of the market should pick up a little more than they have. So we'll have to see what happens there.
So it seems that you expect the market to continue its uptrend in the second half of the year as well. So what will drive the performance in the back half? You mentioned there may be Fed rate cuts. How many rate cuts do you expect? Do you expect earnings to improve further, or do you expect multiple expansion?
Yeah, so I expect earnings to continue going in the right direction, basically. So I think corporate earnings, particularly for the tech stocks, will continue to deliver and perhaps, beat expectations or meet expectations. And I think we'll get some momentum from that. These companies for the last few years have really figured out how to become efficient and cut costs and invest in kind of like the right parts of their various business models. And that's starting to play out for all of them, whether it's Meta, Microsoft or Amazon. I just think that they're doing a lot of things that are kind of shaking out earnings for them now, and that might continue. I think the other thing is that, there's all this cash that remains on the sidelines. We always talk about this, and there's a big group of people, investors out there that are still, happy taking their 5% of, kind of like treasury yield types of returns, CDs, things like this. And, once you start seeing equity markets rally to the tune that they have this year, I do think some of that money comes off of the sidelines and starts to fuel additional, kind of like liquidity and trading and market growth. And then, to your question, how many times are they going to cut? I have no idea how many times they're going to cut. I suspect we're going to get at least a cut, but I also know that directionally the cuts are coming versus hikes. And so that's kind of enough, I think, to sustain the market for the next 6 months or so. And again, election year, summer seasonality, I think that we're going to end the year strong. I don't see any, unless there's a, major geopolitical issue or inflation starts, turning around and completely going the other way. It's hard to see why that would happen, now. Not to say it didn't happen before, but I do think there's less of a case for that to happen now. And so I am bullish about this market holding up.
Right. Cash has been really interesting. It's surprising to see so much of cash just sitting on the sidelines. And even if a little bit of that comes off the sidelines and gets invested in stocks, that would be great for stocks. So we are recording this on June 27th, and year to date, the S&P 500 index is up about 16%, and the NASDAQ 100, thanks to NVIDIA and other tech giants, that's up almost 20% year to date. So do you expect the rally to continue at this double-digit pace, or do you expect the rally to moderate a little bit? And you mentioned that you expect the rally to broaden out a little bit beyond the technology giants. And in fact, as you mentioned, last week, NVIDIA took a well-deserved break, but we saw that other technology giants like Tesla and Amazon, they started rallying. It would be interesting to see if some of the mid-cap and small-cap stocks join the rally, right?
For sure. And I think small cap, once you get that rate cut, I think that's your tailwind for small caps, right? I think there's a little bit of a kind of like a psychological aspect to that, that cut, right? Because then it becomes more practical that they can kind of service their debt and continue to do their R&D and grow and things like this. So I think so. The other beneficiaries in the market, I think, will be companies like healthcare. When AI starts really filtering into these, whether it's weight loss drugs, perhaps it goes from an injection to a pill. I think, the scale of increase on that stuff, and then even surgeries, robotics. If AI quantum computing do the job that they're supposed to do in terms of like helping process data and help guide research solutions and things like this, you might see more types of pharmaceuticals around cancer treatment, around obesity, diabetes, around Alzheimer. I mean, you're hearing all this stuff daily come out, and I think that healthcare will start to really get that rally. We've been waiting for it. Post-COVID, we thought everybody's going back to the doctor, having surgeries again. Large baby boomer population, and a couple of names are rallying there. But I do think you're going to see that expand more. I think 5G is going to be a thing again. And, that's because you essentially need this low latency and connectivity in order for AI to work. And, we've kind of put that to the side for now. It was the hot topic of COVID, but I think it's going to become a hot topic again. What might even be 6G. And then I also think commodities like uranium and copper, we're trying to go carbon neutral, right? So we need to find some sort of clean energy solution to fight climate change. Nuclear energy fits that bill. And then, B, to power all these data centers for AI. And so it's so interesting because AI and those so why are those names going to continue to grow? I mean, every single thing we just said relies on that to play out too. And then I think there's parts of the market that are on sale, like software. I don't think they've done, companies like Salesforce have done a great job with AI yet. And I think once they get there, it's going to be a different ball game. And also companies like Palantir and Defense AI, all of it has a shot, I think, to rally.
So the AI rally, which has driven the market this year, that is driven mainly by NVIDIA. And that's not surprising at all because NVIDIA, everyone wants NVIDIA's chips. A couple other stocks like Dell and Supermicro have also done very well. So it seems that in this next phase of AI trade, you expect other areas within AI to benefit. Are you particularly bullish on software and services stocks? And could you talk a little bit more about your favorite AI stocks?
Yeah, I mean, I think my favorite AI stocks for now are just going to remain, it's kind of a boring answer, but it's going to be, the Broadcom, the NVIDIA, AMD, Micron, Intel, the Microsoft, Amazon for cloud computing and things like this. And then also the cybersecurity companies, whether it's like the Palo Altos or the CrowdStrikes. I just think that these companies are still the providers. And until, the service has been kind of like provided and tweaked and other players enter the space, they're going to be the winners. But then I do think you have these smaller companies like IonQ and D-Wave that we don't talk as much about. And they're more in like the quantum computing, supercomputing space. And again, like you need to process all this data quickly and efficiently in order for it to continue to, grow and scale. And so those will be like the smaller cap types of names or, smaller, at least in the segment that they play in that I'll be looking at.
Very interesting. Now you mentioned uranium earlier, and we know that this AI race is heating up. So all these technology giants, Microsoft, Google, Amazon, Meta platforms, they are spending tens of billions of dollars on data centers. And data centers are energy intensive, that we know. And AI computations, they require even more energy than traditional computing. And these technology giants, they have sustainability goals. So many of them have pledged to use renewable energy to power their data centers. So that is why nuclear energy has been very interesting. It is one of the cleanest forms of energy. And you launched a uranium ETF recently. Can you talk about your bullish theme on uranium and a little bit about that ETF? And you mentioned copper also. So copper, we know, is used extensively in data centers. How do you recommend investors should play copper?
Yeah, I think looking, there are several copper ETFs out there that are interesting to use. I don't particularly have one that is a favorite. I think they're all, good funds, whether it's, the Sprott product or the Globalx product or whatever it might be. But I think looking at an ETF is a good way to do it. You get access to all of the companies that, mine or have some sort of relationship to the production and use of copper. And, it's basically like running data centers creates this massive level of energy need and also heat and, electricity demand and things like this. And so copper is a great conductor for this and essentially helps support the, kind of like the running, the bricks and build out of AI. And then, for uranium, nuclear energy, we know is, allegedly the cleanest form of energy that there is. And if we're looking to go carbon neutral, it's essentially, one of the top candidates to be the type of energy that we use in order to get there. And then on top of that, I just think that you have some really good opportunity in uranium because of geopolitics. There's a ban on imports from the U.S. government. There's also the U.S. government investing in the U.S. to further mine and access uranium. Geopolitics plays a role, obviously, and supply and demand. Both copper and uranium. Any of these, kind of like minerals mining is in high demand right now, and in low or too low of a supply for the potential future needs that we all have globally. And so I do think that those are areas of the market that investors can look at. For uranium, we have an ETF that tracks it, URAX, and there's other ways to do it too. So yeah, I think that those will be really, and those are good diversifiers in a portfolio too, right? They're sort of, alternative in terms of, kind of like equity market performance and things like this. So interesting to allocate there.
Interesting. So I wanted to go back to healthcare sector that you mentioned, and that has been pretty interesting. It's been like a tale of two cities in the healthcare sector. So there have been a handful of stocks that benefit from this GLP-1 drug mania, Eli Lilly and Novo Nordisk. And a few others which have done very well. And there are others which have just been in the doldrums. You mentioned AI. So I think that's going to be a major theme going forward, the use of AI in drug discovery and detection and treatment of diseases. That is going to be huge, I think. Do you have any particular favorite stocks in the healthcare space that may benefit from these themes going forward?
Yeah, I think you named my top two for now. It's hard not to like, Lilly and Novo, just because of the leadership in the GLP-1, and I think it's continuing to grow. But I think that having, also broad-based exposure to the sector makes sense. Again, I kind of like my ETFs, right? But if you look at the XBIs or the IBB, or like the Straight Street healthcare ETF, I think that investing in healthcare gives you a lot of unique advantages. Again, first we talked about the aging population, right? So as the global population grows and ages, you have this massive demand for healthcare services. And so having access to, many companies that focus on different types of medical care, different types of treatments, whether it's, chronic diseases, age-related diseases, demographic trends support the demand for healthcare services. And then, we talked about AI. I think it's a massive hub for innovation. So, if you have advancements in medical tech and drugs and medical devices, and you get these like breakthroughs with diagnostic tools and are able to really personalize medicine for, every single person through the use of AI, I think it's a game changer. And again, there will be many winners in that space. And it's defensive, right? So it tends to be less affected by pullbacks. People need healthcare no matter what. And I just think that, there's a really good investment case, and it's almost like Eli and Novo, or like the NVDA and the AMD of today's market, in healthcare. So I think single stocks for you can look at those two for single stocks exposure, but if you just kind of want to play the whole sector, that's really not a bad way to get exposure either.
Right. Now, switching gears a little bit, I wanted to talk about ETFs that use option strategies to generate exceptionally high income levels. And these kind of ETFs have been immensely popular over the past, particularly over the past couple of years. And in general, in addition to high yields, these strategies generally reduce portfolio volatility as well. Defiance offers some of these ETFs. Could you talk a little bit about the reasons for the surge in popularity of these strategies?
Sure. I think that, there is this huge population of individuals that are, set to retire or are retiring, and are retired, and they essentially live off of income, right? So the ones who live off of income and actually take the income are probably looking for, a nice dividend paying stock, or an, options enhanced income type of product where, the NAV and their initial investment stays pretty steady, and they get to take that income and live on it, right? And that's, that's nothing new, but it's just a new vehicle to do it, because usually that's just been, kind of like bond investing and maybe div growers and stuff like that. So this is this whole new space now that provides this income. The second thing is that, those who are set to retire maybe like these products because they get some income, and, they can either take a portion of it or reinvest it to get, future growth. But they also like some of that, a little bit of the higher risk equity exposure within the product. So there are products that seek to pay very, very high types of dividends. They have a little more equity, a little bit more equity, risk, but overall it's kind of less than the underlying index if they were to invest in it. So for example, a fund like QQQY seeks to pay, these high dividends, and it's been in the range of 60% annualized. And so what we do is we sell, slightly in the money puts that expire within 24 hours. So 0 DTE options, 1 day to expiry options, whatever it might be, less than a day. And they generate this high level of income, and they participate in some of the upside of the underlying index. But then on the downside, to your point about like why they're less volatile, if you think about, NASDAQ having a pullback, these funds would do a little bit better than that because each day they're generating income. And so while you would experience that downside performance at the NASDAQ, you'd also generate a little bit of income, making your, kind of downside risk a little bit less. And so I think that there's this huge group of people out there that are, really in favor of the idea of having equity exposure with robust levels of income, whether it's to reinvest it or live off of it. And so, we play in both spaces. And on the target side, for those who are kind of expecting a steady dividend, little less dividend, but more upside performance, those products target like an SPYT and QQQT, they target 20% annually. And what you do is you sell covered credit call spreads instead of just covered calls. And so you kind of, untap the nuances or the roadblocks of a covered call so that you can capture more upside performance. So yeah, I think, they're taking off just because people want high income products.
Yeah, it's been a very interesting trend. So in general, investors should remember that these strategies work best in sideways markets, and they underperform in very strong bull markets.
Yes.
And as you mentioned, they do provide some protection when stocks fall. So in your view, what kind of investors should use these ETFs, and how much allocation to these strategies do you generally recommend?
So it's really interesting because we've just spoken to so many different types of investors that use these products in different ways. So you have, the registered investment advisors and the institutional types of clients. They use this in their alternative income sleeve, and whatever that percentage is for them that they allocate to, that's where it's going. So some have 5% in that type of allocation, some have 10% in that type of allocation, and they're kind of they set it and forget it with these products. They're not looking to manage them. They reinvest the dividend, and they drip and compounding over time. There are retail clients that solely use these types of products now, and what they do is they capture the dividend every month, and they either reinvest some of it or take some of it away to reinvest in a different type of stock that they might have. And they have sizable positions in these types of products, and so it really varies, but it's a very good alternative income type of allocation, or it's a good complement to your basic, like if you hold QQQY along with your QQQ position, you're getting NASDAQ 100 exposure, so you'll get the run up on the upside, but you're just juicing up your income by putting the enhanced income version of that product alongside of that fund. So, it could be used in different ways.
Good stuff, Sylvia. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Thank you. Thanks for having me.
That was Sylvia Jablonski of Defiance ETFs. Now, let's recap some of the tickers that we discussed and talk about some more ETFs. So she talked about technology giants. We all know the tickers. NVIDIA is NVDA, Microsoft is MSFT, AMD is AMD. These are some of her favorite technology stocks. And if you want to invest in these technology giants, the best ETF, in my view, is QQQM. QQQM is the cheaper version of the ultra popular QQQ ETF, and because of its lower expense ratio, it is more suitable for longer term investing. She also mentioned quantum computing to benefit from AI trade. The ticker symbol of the Defiance Quantum ETF is QTUM. Quantum, easy to remember. For healthcare, we talked about Eli Lilly. The ticker symbol is LLY. And Novo Nordisk, the ticker symbol is NVO. And we talked about investing in copper and uranium. For uranium, the ETF that I like is the Sprott Uranium Miners ETF. The ticker symbol is URNM. This provides exposure to global companies which are involved in mining of uranium. And for copper, the ETF that I like is by Global X. It is the Global X Copper Miners ETF. Ticker symbol is COPX. COPX provides exposure to global copper mining firms. And in full disclosure, I own both Uranium, URNM, and COPX, as well as QQQM in the ETF investor portfolio that I manage. Now, if you want to look at these options-based ETF for high-income seeking investors, there are many that investors can choose from. The one she was talking about is the NASDAQ Enhanced Option Income ETF. The ticker symbol is QQQY. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.